Imagine the very foundations of our financial trust beginning to shake. This isn't lifted from the pages of dystopia. It's the real-world phenomenon known as a bank run. When whispers of a bank's instability turn into a roar, fear compels people to withdraw their money en masse, fearing an empty vault. This moment, where panic eclipses reason, puts our financial stability to the test. Through the lens of history, from the dark days of the Great Depression to the 2008 financial crisis, each bank run maps out a timeline of fear and shattered confidence. Our journey through the understanding of bank runs reveals the reality. Our financial system, robust yet vulnerable, and our collective role in safeguarding financial stability. As we explore the psychology of panic, remember, these episodes of financial turmoil teach invaluable lessons on trust, fear, and the essence of financial stability. In the complex landscape of finance, a pervasive fear lurks, capable of morphing serenity into turbulence. This dread, rooted in the unpredictable nature of our financial networks, sparks a primitive, herd-like response. It's a powerful fear, the kind that can precipitate a bank run, leaving one to wonder what drives people to suddenly withdraw their trust and their money. Central to this enigma is a web of psychological triggers. Fear, magnified by unsettling news or rumors, races through communities, igniting doubt and triggering a crowd-following instinct to safeguard assets. This segment delves into the psychological underpinnings of bank runs, exploring not just the actions, but also the emotions fueling them. As we further dissect the impact of bank runs, we recognize the deep human elements at play, emphasizing that their ripple effects touch lives and communities, extending far beyond mere economic implications. Within the annals of financial history, the specter of bank runs emerges as a disruptive force, highlighting patterns and triggers that span across eras. Two significant periods, the Great Depression and the 2008 financial crisis, serve as prime examples of how fragile financial trust can lead to widespread panic. The Depression saw a stock market crash evolve into a full-blown panic as people frantically withdrew savings, revealing the precariousness of banks' liquid reserves. Fast forward to 2008, and we witness a similar scenario, a crisis of confidence magnified by digital media's reach, proving yet again how public perception plays a critical role in a bank's health. These narratives reflect the consistent ingredients for bank runs: fear, dwindling confidence, and inherent operational risks within financial institutions. Drawing parallels between these eras underscores the unchanging nature of financial vulnerabilities, whilst also pointing to the evolution of response mechanisms over time. As we transition to examining media's influence during financial crises, we connect the dots between history, perception, and the pivotal role of responsible communication. The unfolding story of bank runs casts the media in a potent dual role. Historically, media outlets have escalated fears, turning whispers of financial trouble into a chorus of panic. This delicate balance positions the media at the fulcrum of financial stability and chaos. The role of journalism, either fueling rushes to banks through sensationalism or stemming them with factual reporting, highlights the thin line between responsible communication and spreading fear. This exploration into media's impact dissects how narratives can either precipitate a financial stampede or help restore calm by affirming trust through accurate, timely information. As we proceed, the focus shifts to the regulatory responses inspired by these dynamics, illuminating how the intricate relationship between perception and reality is navigated in the financial domain. In response to financial upheavals, governments and regulators have devised measures to quell the panic, leading to bank runs. They understand that confidence is the bedrock of economic stability. Initiatives like insured deposits offer solace to individuals, assuring them their savings are protected despite a bank's dilemma. Banking regulations, addressing operational stability, mandate liquidity and reserve adequacies to dismantle fears and avoid systemic scares. This architectural web of regulations springs from historical tumults, aiming to cement confidence in the financial system. As we navigate through evolving financial crises, the adaptation of regulatory frameworks spotlights a commitment to reinforcing the banking sector's resilience, thereby instilling a sense of collective security. Bank runs embody a broader narrative of economic fragility and systemic risk, transcending individual institutions to highlight vulnerabilities across the financial landscape. Their aftermath not only constrains credit but also hampers economic growth, affecting jobs, investments, and consumer confidence. The erosion of trust in banking can lead to a conservative financial approach, inadvertently hindering innovation and prosperity. Moreover, significant incidents provoke regulatory introspection, often culminating in enhanced legislative guardrails. As we pivot towards examining preventive solutions, it's vital to embrace our collective responsibility in mitigating such economic disturbances, ensuring our financial framework's integrity for the future. The narrative of financial safeguards unveils a realm where technology and innovation converge to shield against bank runs. Envisage a banking system equipped with predictive tools and mechanisms to neutralize potential crises. This is the promise of modern fintech. Technologies like blockchain and AI-driven analytics exemplify the frontier of banking's evolution, targeting transparency, trust, and preemptive problem-solving. These innovations aren't just countermeasures, but pillars supporting a resilient, inclusive financial ecosystem. As we explore this synergy between cutting-edge practices and banking's future, we transition seamlessly into a discourse on the personal and societal impacts of financial stability, highlighting the transformative potential of these technological solutions. This journey illuminates the deeply human side of financial crises, where each statistic represents individuals and communities facing unprecedented challenges. Stories range from entrepreneurs wrestling with financial constraints to families guarding their savings. These narratives underscore the tangible impact of bank runs, not measured in monetary loss alone, but in the stunting of aspirations and communal strife. Yet, within these stories of adversity, resilience blooms, communities unite, and innovation emerges as a beacon of hope. As we conclude this segment, we're reminded of the human stories woven into economic events, urging a future where empathy and proactive measures prevail, crafting a narrative of resilience and collective fortitude. Traversing the historical landscape of financial crises reveals a recurring motif of vulnerability juxtaposed with resilience. From the depths of the Great Depression to the recent tremors of 2008, each event, though unique, shares common threads of human and systemic fragility. This analysis not only juxtaposes the similarities and differences across episodes, but also distills lessons pivotal for preempting future crises. It underscores the importance of trust and the impact of preventive strategies aimed at reinforcing financial institutions. As we approach the narrative's conclusion, it's evident that learning from the past is integral to navigating future economic challenges, emphasizing the role of vigilance, innovation, and a collective commitment to financial stability. In the intricate dance of financial stability, where confidence sways markets and shapes destinies, our collective vigilance stands as a bulwark against future uncertainties. This journey through history fortifies our resolve, highlighting the erosion of trust and the pathways to resilience. At this juncture, empowered by insight and a communal ethos, our obligation is clear: to foster an informed, accountable, and united front against the specters of panic and instability. By weaving a fabric of shared responsibility, we anchor our economic future in strength, security, and prosperity. Let this collective endeavor be our legacy, ensuring a robust financial world for generations to come. In unity, we find strength; in awareness, the power to forge a stable, thriving global economy.